I went to Chicago, and I think we always have a preference for things that are rooted in economic history and economic fundamentals to a fault, even when they kind of don't make sense currently, potentially. That said, there are no two periods in history that are exactly alike, and you can always add a qualifier to them. And I can't think of any time in history that's exactly like this. But what you can do, and I think can be meaningful, is you can look at how correlations or how assets tend to move in tandem during certain periods. And I think that may be an easier context. The one kind of wrinkle lately is like the Fed is very different than it was decades ago, right? So that's kind of putting a monkey wrench into the whole thing.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunne, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunne.
Thanks very much for that introduction, Niels. Today I'm joined by Elizabeth Burton, who is the Chief Investment Officer of the State of Hawaii Employment Retirement System, a $25 billion public pension plan. Prior to taking on that role, Elizabeth had a diverse background in the investment industry as a trader, as an economic researcher, as a consultant, and as a hedge fund allocator. Elizabeth, it's great to have you on the podcast all the way from sunny Hawaii. How is everything today?
Everything's great. Thanks so much for having me.
Well, it's great to have you on. It's a very interesting time to have you on with such a lot going on in market. I did a little bit of an intro on your background there, but maybe to set the scene, can you talk a little bit more about that background and what you've done in the investment world and even prior to that and what has taken you to your current position as CIO in Hawaii?
Sure. So I have a pretty non-traditional background. I've been here at Hawaii just over 3.5 years. Before then, I was the head of risk for Maryland's then, I think, $55 billion plan. I'm sure in COVID, they've increased their assets substantially. And I also was managing director of their quant strategies group, which does include quant strategies, but also includes other illiquid type strategies. And then, but I had kind of a strange trajectory before there, and it's a long story. But basically, I worked in payments, M&A. I worked in consulting. I was an expert witness econometrician for a couple years. I worked in hedge funds for a large South African insurance company, and then kind of started out in the industry on the mortgage-backed side, trading pass-throughs. So. Been a really long, winding way here, but I think it has made me a pretty well-rounded CIO at the end of the day.
Very good, and obviously it's a very interesting and fascinating role you have managing, $25 billion dollars in assets. In markets we're experiencing at the moment, it must be particularly challenging and interesting. We've had quite an eventful start to the year with a sharp correction in growth stocks in particular, but equities and bonds both down on the month of January. And obviously a lot of people have been saying this is the possibility that we might see going forward, challenges for the 60-40 portfolio. What's your perspective on what we've been seeing in markets to date this year?
Yeah, I mean, it's an interesting question. I don't know a ton of people who are still, at the 60-40 portfolio allocation, except for maybe smaller type plans without an investment office. For us, the 60-40, the 60 still exists. The 40 looks like something else.
Okay.
I agree the markets are kind of in an odd place. Equities look expensive. But when I hear that they look cheaper relative to the fixed income side, that's not really what we're comparing it to anymore. And I think we also have to keep in mind that, over the course of history, equities have been positive. I'm going to get this wrong, but let's call it like 80% of the time. So we can't just be uninvested in those markets, right? Although I would say I don't think anyone would be surprised if what happened last month continues, where we have like these, 5 to 10% dips in the market. And I think we should all kind of be prepared for that. But my biggest concern has been for the last 2 years that we're going into a sustained inflationary environment, and running a public pension and making sure that we have the benefits to pay out retirees and that those dollars are meaningful to them is probably my biggest concern.
Interesting. And I'm glad you touched on that, because obviously you're managing a public pension plan. So it's not an unconstrained mandate, I guess. You've got to keep an eye on your liabilities as well as the asset side. Could you give us a bit of a sense on that of, how different it is managing this type of portfolio versus a hypothetical unconstrained portfolio?
Sure. And, I'll probably be a little bit biased on my side of the table here, but I think in general, first of all, we're about 55% funded. We've improved that funding ratio over the last 2 years since the equity markets kind of ripped and our private markets portfolio did well, but we're still quote unquote underfunded, and we have a 7% return target. So I think versus other plans that may be fully funded, really their cost of capital is essentially maybe LIBOR plus, right? So
Okay.
our cost of capital is 7. We've still got to hit that return hurdle. And it's not as easy as maybe, some other institutions where we're just trying to swing for the fences. The board of directors of Hawaii has set out some risk parameters and some, investment policy rules that they kind of want to navigate around. So my job is to try to get a 7 or better within those types of constraints, which can be challenging. At the same time, like having, carte blanche, I think could probably also be challenging. So
Yeah.
So I think that's the main difference.
Yeah, no, it's interesting. I mean, you touched on how the 7% is challenging, and I've seen those charts before where if you go back to, say, I don't know, I guess it was 2000 or so, you could get 7% probably from a fixed income portfolio in US dollar assets. Is the 7% target, is it realistic, or is that not something you even worry about? Is it just that's the target you have to hit?
So I often feel like a little bit of a hypocrite with this question, because while it's very hard to eke out an extra 10 basis points of return in any given year, I think it's very hard to say whether hitting 6% or 5% or 7% is easy, right? Like I just don't have a crystal ball on that. I think it's challenging across the board. I think to your point about you could just you used to be able to just do this with fixed income. Now there are a bunch of other asset classes where public pensions are investing in, especially on the private side, which can help add to that, that return bogey. So real estate, for a good example, might be something, U.S. value add, for example, going out the next decade or so might be a place we can pivot to, where that wasn't as common for plans, 10, 20 years ago. And then obviously private equity. So there are other levers that we can pull that weren't available to us and were available to other investors in the past.
Okay. You touched on, inflation being a big concern in your kind of framework, and obviously that's been a big topic in markets really for the last number of years, but certainly the debate has heated up since we've had the COVID pandemic. What's your own base case in terms of the outlook for inflation?
Yeah, I mean, I have been a little bit of a broken record on this. For the last 2 years, I really thought we were going to see a sustained period of higher inflation. I just didn't see a path to where that wasn't going to happen with all these, relief payments or transfers, whatever you want to call them, and the building up of inventories, et cetera. So for me, I do think that we're in for a period of sustained inflation. I'm not calling for 5 to 7% to go on ad infinitum, but as you know, and as listeners probably know, that inflation closer to 3 can be problematic for equity markets in general. But for us, it's not just growth side of our sheet, as you mentioned earlier. Like, we have our liabilities, right? So some people might say, like, that's the discount rate changes, and that could be positive for us, but also we care about real returns, and we care about real dollars. So that's like the bigger issue for me. And I think what's really surprising to me is that we've been through decades, literally, of negative real returns to portfolios. And for some reason, I feel like everyone's kind of ignoring that. I mean, it happened as recently as the 90s. So for me, like, that's something that we really have to pay attention to, because my job isn't just to hit 7, is to hit like a meaningful 7. And some public pensions have real return targets. We don't have that, but that's something that we probably should consider.
Yeah, you touched on that point about the 90s being, I guess, a lost, I guess the 2000s for equities in real terms, and probably the 70s, say, for fixed income investors. I mean, how much of kind of a macro call do you make on that? I mean, if you had obviously complete foresight that it was going to be a lost decade for equities, looking ahead, you obviously could fundamentally reorientate your asset allocation, but you don't have that. So, I mean, how do you balance the portfolio with one eye on a kind of a macro view for the next 10 years, or do you take that kind of a macro perspective?
Yeah, I mean, I think you have to think about what the biggest risks are your portfolio, and then you can decide whether you care or not, right?
Okay.
So if we look back at kind of that period, I think the equity markets returned around a 6%, but you also had inflation around 6%. So when people just go back and look at the data, that you're not really seeing the problem there. But for us, just like anyone, you got to think about the biggest risk to your portfolio. So why is another reason I care about what the inflation print is? Because a lot of public funds run their asset allocation off of mean variance optimization, and a big input into those asset prices or forward-looking projections is inflation, right?
Right.
So it makes a really meaningful difference about where you want to put your dollars to. And I think asset allocation is a huge driver of returns. So you've really got to care. And I totally admit I could be wrong about this inflation call. But I don't think that just because you could be wrong, you can't start building protection into your portfolio. There are a lot of risks out there that people protect liquidity, for example. So like 5 or 6 years ago, maybe you were worried about liquidity in the markets. You couldn't possibly have anticipated COVID, but it doesn't mean that you weren't right to kind of start thinking about ways to navigate around that. And I feel the same about inflationary risks. Also, kind of luckily, maybe lucky is the wrong word, but some of the things that would help an inflationary environment post-COVID are actually some of the strategies we're most bullish on. So like our real assets portfolio.
Okay. So it's a little bit underweight fixed income relative to some other plans that are a bit more tilted towards real assets. And that's partially reflecting that your major concern, as you say, being inflation. Is that fair to say?
Well, we were really underweight when I got here 3 years ago, real assets.
Okay.
Very underweight, I think, compared to most plans. So I think we're coming up normalization, but I would say we've been taking down our fixed income portfolio, and I don't think we're alone in that. I think, your traditional fixed income is definitely looking more credity.
Yeah.
And then there's a bunch of alternatives to a fixed income now. And I really hate that phrase, because almost every conference you go to there's like some panel on fixed income alternatives.
Right.
But it's a good question.
Yeah.
There are things out there that pay a very low return for minimal amounts of risk that may do better than negative real returns in the fixed income market.
Okay. It's interesting. I was looking at your portfolio asset allocation. It's publicly available on the website. And it's split into three broad categories. So it's broad growth strategies, I think, diversifying strategies, and other. So, I mean, at a high level, is that how you categorize all of the different broad asset classes?
Yeah, so we can ignore the other or the opportunities class. That was kind of a holdover of some single direct assets that we owned that didn't necessarily have a great place fit in the portfolio. We've since really gotten rid of that. There's no target for that asset class. But yes, we basically see the portfolio in two parts, growth and other. And so other is kind of that diversifying. And you can kind of think of it anything that's, got key risk drivers that aren't supposed to be dominated by growth aspects. Although, we all know that in certain environments that those correlations kind of break down. And I have to admit, when I first got here, they had more buckets, and it was challenging for me because they have a different way of bucketing things. But one of the things I really like about how Hawaii does it now is we never run into the problem of a really interesting investment coming to us, and we don't say, sounds great, but our XYZ guy doesn't want to do it, or it doesn't fit in this bucket. We don't have a bucket problem. And I think, this about me. I'm not really a big fan of asset class categorizations. I think all asset classes are kind of converging to one anyway. And so for us, having that flexibility to say, okay, we just want to know when, things go south, whether it made sense or whether it didn't, and that's how we're bucketing it, really gives us a ton of flexibility.
Interesting. That's quite an interesting perspective. Asset classes are converging to one. So is that in the sense that it's a risk asset, or it's not, and it's just, you just have different shades of risk? Is that it?
Yeah, I think exactly. So interestingly enough, the kind of the origins behind this, and I wasn't even here when this happened. So this was 2008. But the Board of Trustees was looking at what was happening in the market. Well, take it back to 2007, let's say. So 2007 to 2009, the Board of Trustees was looking at what was happening in their portfolio. And they had traditional buckets like U.S. equity, U.S. fixed income, et cetera, et cetera. And based on what the investment staff had been and the consultants had been educating them over the last number of years, it didn't make sense why everything was moving in one direction at given times, right? And so they said, okay, it makes more sense to us if we just know what the risk drivers are behind these different things, so that, if correlations go to one and everything draws down, it kind of makes sense to us. So that was the origin about how it kind of came about. They just want to know what to expect. And I actually think, like I said, it was really hard for me to get used to that at the beginning, but now I think it kind of makes sense. And maybe my philosophy will change down the road. But I do really think these asset class definitions don't make a lot of sense. So I was at a conference last week, and they had a topic called, is private credit an asset class? And kind of like, who cares, right? Well, how does that change how you allocate if it is or isn't an asset class? It's an interesting philosophical debate, but does it matter?
And would private credit then be in growth or diversifying from your perspective?
I think it depends on what type of private credit it is. So we have, and this goes back to my asset class definition. We have some obviously in our growth bucket, and then there is some in diversifying for sure. But what is the driver behind those different segments of the market? And also, there are some return bogeys in there, some cost of capital come into play. But that's kind of exactly to my point. Why do we care kind of about bucketing, right? If it has a place in the portfolio and it can compete against other assets, then it should be in there. So we actually had a discussion yesterday about not a private equity investment, an investment in our public portfolio of a private. And I think the whole point was do we want this? And if we want it, does it beat what we have in our private equity portfolio? And if it doesn't, then kind of why are we doing this? Because we're not trying to make money in each of our buckets. We're trying to maximize the portfolio return, and we don't want to be taking duplicative bets, and we don't want to be taking offsetting bets. I don't mean offsetting volatilities. I just mean offsetting bets. And I think that that's something that has kind of gotten lost in the, I'll say, cuteness of these mean variance optimizations, and trying to figure out who's covering what asset class. And part of that, to be honest, is because it makes staffing hard. But I think family offices would say it doesn't make staffing hard. I think it's just on our side, these big institutions, how do you organize hundreds of billions of dollar portfolio if you kind of tell everyone it's one book? It's hard. I get that.
Yeah. So I'm picking up this skepticism of mean variance optimization. It sounds like there's a few different dimensions to this. What is the big gripe with mean variance optimization?
I mean, obviously, I wish I had come up with it because it's a great paper and it sounds really smart. And in some respects, what could you do better, right? But as a former econometrician, like assumptions upon assumptions upon assumptions just leads to really bad assumptions, and that's basically what you're doing. And you're kind of lying about the volatilities, and you're also kind of lying about the look back on those volatilities, right? So even if you take, let's say you sit here and you take a 20 look back on those vols, I don't even think like 20 years is a very relevant form of data. And the structure of the markets is so different than it was, 80 years ago, 100 years ago, that there's just so much baked in. And everybody adjusts their private equity numbers because, as you know, if you actually like reflected what was happening in the private equity volatilities, you come out with a very different very different outcome, right? And you can't, or most people won't have 100% invested in private equity. So to me, I prefer more of a common sense approach, but people are uncomfortable with the common sense approach, right? They want some guardrails around it. So it really drives me bonkers because you also can just feed so many things into there. So you might have 0.5% allocated to this one asset. Well, that's why. Why would you do that?
So is it that you can just get solutions with mean variance optimization that you wouldn't really just buy into from a common sense perspective?
I think ultimately it is confirmation bias at its worst.
Okay.
That's what it is.
Yeah. You can use the tool to get the result you want, basically.
Exactly.
Yeah. It's interesting. I mean, you touched on this debate about looking back into past data. Are the markets different to what they were 80 years ago? Do you use that kind of tool, historical perspective, as an input into your decision making?
So yes and no. I went to Chicago, and I think we always have a preference for things that are rooted in economic history and economic fundamentals to a fault, even when they kind of don't make sense currently, potentially. That said, there are no two periods in history that are exactly alike, and you can always add a qualifier to them. And I can't think of any time in history that's exactly like this. But what you can do, and I think can be meaningful, is you can look at how correlations or how assets tend to move in tandem during certain periods. And I think that may be an easier context. The one kind of wrinkle lately is like the Fed is very different than it was decades ago, right? So that's kind of putting a monkey wrench into the whole thing.
And you think it's different in terms of this perception of the Fed put and gradualist approach that they've had, and kind of the asymmetric reaction function, the bias to ease. Is that what you mean? It's different to in the past?
I mean, I think their mandate changed, right?
Right. Yeah. No, that's true. Yeah.
So I think that's a large part of it.
Yeah.
They're trying to solve for two things now. So I think that it's just a very different context. And you look, a lot of, like, I'm not old, but most of Wall Street is younger than me now, right? On the desks. And so I think that it's just a very different environment where we haven't seen things that we saw in the past. And so we have to take to account the actors, and like the two largest actors are probably those like who are trading these markets, and then the Fed, right? And they're both in very different places now.
And I mean, it's definitely a valid perspective and interesting, but taking that, is that just a message of caution and that the world might be a lot less favorable in the next decade, or is there anything else you can take from that perspective that you might act on?
I think caution and skepticism, and do things make sense? I think is it kind of goes back to what I was saying about equities. You could say that they're too expensive and you should pull back, and then you might also say, well, but they are positive about 80% of the time, and you should move forward. So I think it's just not relying. It's like your quant models at a CTA, right? You don't want to rely too much on the historicals because there's so many additional variables in there.
Yeah, interesting. I guess what it sounds like is that you've emphasized kind of this common sense approach, and it sounds like more robustness over optimization. Is that fair to say?
Yes.
Yeah. Just moving on from the kind of the whole area of asset allocation to, obviously you have to, populate your different strategies with particular funds or managed accounts, etc. So the whole area of manager selection, and obviously prior to taking on the CIO role with Hawaii, you oversaw the hedge fund portfolio at Maryland. So you've got a lot of experience in the whole area of manager selection, particularly in with respect to quant strategy. So when you think about that challenge, do you think manager selection is a different skill to asset allocation? Is it more or less difficult?
So I think manager selection is much more difficult. It's hard to quantify. Well, I get that you can run an attribution, but it's very hard to quantify for multiple reasons. One, there's no two managers that are exactly the same, which is always funny to me when people say, "Oh, we evaluated these three and we ranked them, and this one came out on top." I just find that impossible. How do you compare the three? There's too much going on in there. But I think it's really tough. I think there's the human element, and that's really, really hard to kind of put a value on, right? Asset allocation, like you can take more of a common sense approach, but like manager selection, there's a ton. You have to know how to evaluate a business. You have to know how to evaluate a team. So maybe private equity funds are really good at this, but they've spent decades kind of honing their craft. So one thing that I've always kind of relied on personally is like the history that I've had with these managers. And so there's very few spinouts that happen these days, for example, where I didn't know the team they came from or people who worked with them. So kind of like triangulating who they are and how their business is, even on the it's not just the PMs, right? It's who's their COO, who's running the operations, who's their ODD person. At this point, like these names are usually in our circle. And so I find it easier to know exactly what I'm going to get out of someone that I've known for 20 years or have heard of for 20 years than someone whose returns might be higher or someone whose alpha sourcing might have an edge. And obviously, we always want to prioritize alpha, but there's so many other things that can get in the way. Especially, I find this hardest in the macro universe.
Okay.
So if you have for example, if you have a single risk taker on the discretionary macro side, let's say he gets like a really, really big call in 2007, but then nothing happens in the macro markets for a really long time. Like what happens to that person's psyche? Do they need a win? How does that affect their risk appetite? And then do they have binary outcomes? Are they using digital outcomes here? So like, and if they got the call wrong, for example, in the elections, a couple years ago, like, did that mean they just lost out on that year's worth of, convexity that all their peers got or whatever? So I think it can be really challenging, especially in the single risk taker model.
Okay. And is that then an argument in favor of systematic over discretionary, or just, well, it seems to be, obviously it is the argument that people do make for systematic, but would that mean, do you have a bias towards systematic then, reflecting that perspective?
I don't have a bias. I like both in different contexts and for different solutions. I think one of the reasons I got into this business is I just love the old macro guys. It was like the wild, wild west of investing. I love the open mandate and I love economics. I love macroeconomics, right? So for me, that's really a strategy I just find fascinating. On the systematic side, I think there's more of something you're solving for. So in our portfolio, a lot of the systematic managers that we have, we're either solving for some sort of a wide range, right? Some sort of consistent form of carry in some. In others, we want a short trading horizon that can kind of, change their signals on a dime if the markets look like they're whipsawing. And then others, we want to have, hedge fund like returns with a much lower cost, or we just need momentum exposure or something. There's so many different things you can use them for. So I think like one thing that we, back trying to think, 4 or 5 years ago, I think they had a 2% allocation to commodities. Well, I don't want a long only allocation to commodities. So you might be able to use systematic managers in that context, right?
Yeah. And going back to the macro, and as you say, the macro world is fascinating. There's always a story. There's always the next big trade, and every few years, it's like, oh, this is a great environment for macro. And I love the macro debate as well. But it doesn't always necessarily play out like that in terms of the opportunity set or the performance. Is there a risk that you kind of get seduced into saying, oh, that's so interesting and there's bound to be opportunities there, but you can get structural changes in markets that can make it more or less difficult for macro traders, or how do you avoid that kind of, okay, I have a natural interest, so I'm going to always have that in my portfolio, that kind of bias?
Yeah, I think every single time we've said it's a really interesting environment for macro, 90% of the macro managers don't perform, right?
Yeah, exactly.
So it can be really tricky. I think the last 2 years, clearly there were some that had really fantastic years. I think in terms of should it be a constant part in your portfolio? It depends on who you are and what you want to do. But I would actually argue that other than pure maybe fundamental strategy, price targeting strategies, there's no strategy out there that doesn't have some component of macro in it, almost none, right? And so there's a lot of different flavors and varieties where you can get that into your portfolio. And we've seen the rise of the pod shops and multi-strategy shops, and then you've had multi-risk taker macro shops, which I think they also had with their center books a challenging experience over the last couple of years. So it really depends on what you want to do. The reason I like macro is it can literally mean anything.
Yeah.
And I think I hate super constrained investing strategies. I'm not saying on the risk side. I'm just saying on the opportunity side. But it can be really hard to find someone who can flex into that. So I find it very rare that someone who's really, really good at I don't know, let's call it EM to also be amazing at predicting, something in the U.S. commodity markets. I don't know. That's a bad example because those are kind of tied. But so it's hard to find one size fits all.
Yeah.
So then do you pick 4 or 5? I don't know. Then did you just create a giant pass-through model without realizing it?
And what about, if you see traders or investors evolve? One thing I've noticed is the macro community has got a lot more interested in crypto and digital assets in the last couple of years. There's been an institutional flow of money into the space that hadn't been there prior to that. If you had a macro trader who, had been trading, more typical macro markets and now was dabbling in crypto, is that just for the volatility is these days, so that's fair enough? Or would that be, a cause for concern?
My personal opinion on that is that funds get criticized for trading new markets a little too much. I think that one of the things I love about financial markets is that they are always evolving and that people are always finding new things to do. And I don't think that's a bad thing. I think it's a good thing. In terms of crypto, I can't think of really many funds that don't have some exposure to crypto in them. I think almost all on the alternative side do. I don't think it's a big deal. And I want to be careful with that because I know that kind of sounds a little bit crazy. But if you think about what they're doing there, and I don't know if you mean the actual coins or if you mean the rails on the coin side, they're probably only trading a handful of names that we all kind of know. And on the systematic side, they all have stop losses and risk limits and whatnot. So the exposures there are probably not wildly out of control because the volatility is so high there.
Yeah.
On the other side, the multi-strategy funds, I think for the most part, they're more invested in sort of the infrastructure and the hardware than they, or software or whatever you want to call it, than they are in the actual coins. I think it's actually the education side needs to be on the investor side, not so much on the money manager side.
Yeah. And you touched on the fact the different flavors of macro, which is a fair point. And even, systematic strategies like trend following, it's approaching the problem. It's the same problem. You're going to have big moves in markets. How do you capture them? One is with a discretionary view. The other is with a price-based model. do you have a preference? You say you don't have a bias for systematic or discretionary, but how would you weigh up, if you're looking at two opportunities, one's a discretionary macro, the other is a systematic trend follower. Are they comparable, or, you don't have buckets, so you don't say, well, I'm putting one in one bucket, the other in the other bucket. Are those kind of comparisons or differentials difficult to make?
Yeah, so for us, I think there's a liquidity difference typically there, right? So some of the discretionary guys, they could theoretically be in like level 3s, or at least much less liquid than some of the CTAs. So
Okay.
from a liquidity perspective, they might be bucketed differently. I think it depends on what we're looking for. I get that I'm not in the best place to maybe make massive macro calls, but if we do think there's something kind of obvious, like COVID, if we think there's some massive dislocation out there in EM and that we don't have any great way to capture it, then that might be a reason to go look down that path. The one thing I'll say, I'll bring up one anecdote. I was at iConnections last week and had one meeting that really stuck with me and kind of broke my heart, to be honest. But they are a macro fund, quant macro fund, but they have two versions of it. And I won't give away their name because I don't want to butcher it. But one of their funds has a discretionary overlay and one of them doesn't. And the one with the discretionary overlay has underperformed the other one. And I find it so crushing because I really want the human element to win, right?
Yes.
But I don't doubt it, and I'm sure that that's really, really common. And I also think that's a really hard thing for probably the PMs in those positions to admit to. But I want the human element to win.
Well, there is a perspective, isn't there, that the human plus the machine is better than the machine, even though the machine is better than the human. It's not it, but I guess it doesn't always work out that way. But I mean, when you're looking at, you've been to iConnections or any of those conferences and you meet a whole bunch of managers, how do you go about, screening the universe or picking managers? You kind of touched on how you can have a comfort for managers you've had some kind of exposure to in the past, but presumably you don't want to limit yourself to those. Outside of that kind of the past pool of experience, how do you search for new managers?
No, I agree, and I've been, not to give away my age too much, but I've been in the hedge fund space for 17 years now. So I mean, more to the point that if someone tells me they came from a shop, I probably know some other PM there and could kind of background check on them. But I think the most important thing for me, and this goes across all managers, any strategy, emerging, large, whatever, do they have a source of alpha, and is it persistent and protectable? And if it's not protectable, is it at least protectable for the next 5 years? And that's like the number one thing for me. And then you can move forward from there. Like, do they have the right team, infrastructure, fees, whatever? But if there's no clear reason why they should win, then it's not worth a second meeting. And that's actually kind of what I love about iConnections. It's not like you can learn everything in 30 minutes. That's insane. But I think you can hear if there's the potential for them to outperform because they have some edge. And if they can't tell you that in 30 minutes, there's a problem anyway.
Interesting. And I mean, obviously in some kind of, I guess, macro type scenarios or various, somebody might have an information age or whatever it is, that quite clear. For something like, systematic trend following, you've got different shades of trend following. It's a different type of edge, I guess. Or can you apply that framework to selecting trend following or CTAs?
Yeah, I mean I think it is hard, right? You got to trust that they kind of have built a better mousetrap to some extent. But I think you also have to start from, you can narrow down the universe before you even get there. So if you say, I'm looking for something, a systematic macro manager, what are you looking for? What is the time horizon you're looking for? What markets are you looking for them to trade? Like, there's so many variables that you can narrow down exactly what you want. So I think you need to look at your portfolio first and say, what's the whole, not just, oh, I don't have systematic, I should go get this. But I think at this point, look, like almost all public pension funds are pretty mature at this point. There's, right, like we haven't added a state and a new pension in a while. So I think people should stop saying, I'm trying to like fill this bucket or create this class. They should say, I've got holes in my portfolio. What am I missing? Like, what exposures don't I have? And then you can go out and hunt for those. And then you can compare, like, built the models, how did it perform? is this all back tested? What markets are they in? What's the liquidity of those markets? Are they adding new strategies? What's on their research deck? Like, what are the 3 things they're working on right now? Where'd their team come from? I mean, there are ways to narrow it down. It is, I think, for me though, you hit the nail on the head. Like, systematic strategies are the hardest for me to underwrite.
Okay. And you can have a checklist, like, as you say, of, how many PhDs or what's the investment process. But equally, you can have managers with small teams who've a very disciplined process, and they've, kept true to that process for decades, and they've done very well,
Totally.
in many instances as well or better than larger teams. So it is difficult, isn't it? It's not just having your checklist and ticking off all the boxes.
Totally. No, I totally agree. But it is a place to start.
Yeah, it is, for sure. What about the scenario when things go, I suppose, worse than expectations, or you have a manager who's in drawdown, or so you're starting to have concerns about performance? What kind of triggers, I suppose, are the reason for a difficult conversation, or prompt you to say, okay, we need to review this? Is it a kind of a drawdown level, or is it the pattern of performance that you would worry about, or how do you think about underperformance?
So we have a number of managers that are currently underperforming in our portfolio that we haven't terminated yet. And I would say the reason they haven't been terminated is that some of them, we understand the reason behind the underperformance, and we're not surprised, because they're there to perform a function. So we had one manager that was in a drawdown pre-COVID, and then had a meaningful return sort of in the aftermath. And that's what we wanted. We wanted that manager to provide some sort of convexity, right? So that's their function. That's okay. Other situations that did result in a termination is one manager telling us this is how we're going to perform, and literally they were doing like the inverse of everything that we thought was going to happen. I was like, maybe if you reversed all your signals, this would work out. I think the other thing is a good one is if a manager claims they make money on regime calls and they've clearly called all the wrong regimes. Turnover of key persons, tinkering with the models too much. And then, what happens more often than not is focusing on new things coming into the portfolio and new strategies, when there's still some work to be done on the main. But in general, I would say Hawaii, more than anyone I've ever met, is really a long-term investor and wants to see what happens over a cycle and can be very patient. So unless there's major management issues or moral issues or something like that horrific, we're happy to sit through it if we are still convicted in the strategy.
Okay, so it sounds like you're applying your statistical econometrician mindset of, unless it's unless there is statistical evidence to disprove the null hypothesis of is that right? Or
yes, that is how I think about things. I think I mentioned to you in the past that I know how often I'm wrong, and it's a very high percentage of the time. It's close to 50% of the time, having traded the mortgage markets. But I always say, look, I cannot parse through every single bit of information in the world. So what are like the key things that I'm going to take into consideration? And then I kind of solve for my internal 95% confidence interval, and I either accept or reject the null, and then I move on. And if I'm wrong, I'm wrong. But I was confident in that decision. And if I'm not, if I feel like I don't have enough information, I'll go find someone who feels like they do have enough information and see what they think.
And that kind of thinking, from my experience as an allocator, we were typically allocating to quant strategies, and it lends itself very well to that statistical analysis, because the portfolio that you're allocating to is, trading through multiple markets over many samples. So you're going to have statistically periods of underperformance just by chance. The challenge, I guess, coming back to the conversation we were having around the kind of the macro investor and the macro trader who might be having a bad day or a bad week or a bad year, or things going on in their personal life, etc., is, can you apply just that purely statistical lens to that scenario as well, when say, something is going on, or you might have a question in your mind, okay, we thought this person had an edge that seemed very clear, and now we're not so sure. Again, is that a more challenging one to determine?
No, I think it actually might be easier.
Okay.
So signals around there is like if you know their trade construction, and what like how do they typically leg into and leg out of positions, or how do they try to extract some optionality if they all of a sudden change the strategy, like if they didn't used to have only binary type trades in the portfolio and now they do, meaning like in that scenario maybe they're trying to make up for like 5 years of 0% returns or something, right? And they're Hail Marying it. So I think that's one. I think the other thing you can kind of watch for is if they're breaking down their contacts. That's changed a lot, right? So like 15 years ago, you talked to a macro manager on the discretionary side, and it was all about like, I have these key contacts. Well, the world got a lot smaller. You don't have to like fly to Riyadh or something to talk to someone. You can Zoom with them, right? And a lot of people have that. There are literally businesses built on connecting people that, were kind of around 15 years ago, but now everyone has those, right, on staff. So you can look at how they're doing it that way. You can look at one thing that I've noticed is that they'll get kind of flexible in their risk limits, and they might amend those. They might say, okay, well, we used to like if we were drawing down 6, we went to 0. Now, if we're down 6, we go to half. That can be good and bad, but why are they doing that? And how did that pay off? So look at those payoff profiles of when they change those risk limits, or when they, my favorite is when we want to stay small and we're not adding these new strategies, and all of a sudden they're huge and adding all these new strategies.
Right. Yeah, interesting. So it's very much about looking at the process, I guess, as opposed to the outcome is the philosophy.
Yeah, because everyone kind of structures their trades a little different. And it depends on what you want and what you're looking for, and if that fits with you. But if they start changing what they say their process was, then that's a problem.
Yeah. And I know you have strong views, or you have views on the role of consultants in the whole manager selection process. Talk to us about that.
Yeah, I can be a little tough on the consultants for sure. The asset class consultants, I think, can be very helpful. So I am not an operational due diligence expert, and I think that there are a number of firms out there that are really, really strong on that side. And I find them extremely helpful, and I think it's a great form of portfolio insurance. On the investment due diligence side, I think it can be tricky. I think it can be tricky for one outfit to say, we're going to underwrite things that are perfect for your portfolio, right? And even if they have a couple of different options for what you may be looking for, it's very different than a team that spends all day, every day looking for exactly what they want. And by that, I mean us, right? So I think one of the reasons people get into this business, into public funds and into being an allocator, is because you love it and you love doing the diligence and you love talking to people and digging into the materials. And look, it can definitely be an ego thing if someone else comes in and says, well, I don't agree with your diligence, and for that reason, I'm not going to let you do it. And so I think that can be kind of hard. And my best experiences with consultants is when we work together and we share ideas. And if I'm looking at something and I need an extension of staff and they can kind of help fill in that hole and give me another perspective, that's great. But I don't like the menu type relationship. Like, here's 50 funds we have, you can pick from this list, because how does that differentiate you from any of your peers? You're just going to get a market return, essentially like a beta. You're going to get what everybody else has, right?
Okay.
So that's one of kind of my bones to pick. But they are, some are good, some I have more challenges with, for sure.
So is it that not enough cases, like niche managers are being unearthed, and you're just getting the kind of pretty much top of the class type manager that you could pay anybody to go and find the largest or the most obvious names in a given asset class? Is that what you tend to get? Is that the challenge?
I think that's sometimes a challenge, and sometimes that may not be bad. If you're in an asset class where the dispersion of returns are really, really tight around the managers, then fine.
Yeah.
But if that's not the case, then look, it's very hard to scale that. If you have 50 clients and they all want something different and you've got to look at 50 funds per client, that's really hard. That's a hard business to be in. So I get that. But I just wish there was a better way where we could all kind of admit we're not the smartest people in the room. Let's work together and then not say you can and can't do things, and kind of get to the best outcomes for everybody.
Good stuff. So it's just going back to your background. You touched on the various different roles you've had, and, particularly being a trader, you've had a kind of a more research role. You've obviously been an allocator, so you've had that kind of variety in your background. Is that important? Do you think that presumably that has set you up well to step into the role of CIO? But would you say that's the ideal path for somebody to get a lot of different exposures, or what do you think is the kind of experience that one needs to step into a role like you have at the moment?
The ideal path is a hard question. When I think about some of the best CIOs in the business, I think a lot of them did have direct market experience, but they're also all really good leaders. They're really good bosses. I think while I appreciate that I've had exposure to equities and fixed income and commodities and CTAs, and I think that makes me know a little about a lot of different categories, which makes me an effective literal asset allocator, right? Like asset classes. I think becoming like a good boss, a good mentor, a good leader, a good organizer of human ideas is really hard to learn, and I wouldn't say any of those experiences set me up perfectly for that. I actually I talked to him this morning, but for like 5 years I had a management coach who taught me how to be a good boss. I met with him every Monday for an hour to learn how to be a better manager of people, because I'm, other than one person on my team, I'm significantly younger than most of my team here, and they have a lot of experience. And so the challenge for me wasn't so much knowing a ton about each market. It was how to get the most out of these people with decades more of experience than me and really empower them to go out there and do the best in their asset classes. And for me to kind of clear all the other stuff out of their way so they could do that, which I think is very different than what people think a CIO is. Like, you're really a blocker and tackler so that your stars can, go out there and do all the dirty work.
Yeah, that's definitely a different picture than I think most people would have of the CIO, who's kind of making the big calls and, having research analysts feeding their views up, but ultimately you're calling all the shots. So it's the way you paint it is very much more, as you say, more of a manager and mentor and blocker, as you say. I mean, what have you learned in that period of, working with a coach on management and leadership? Anything you're doing now that you weren't doing 5 years ago?
So I think the most obvious parallel for me is that if you think it's someone on a trade desk, like the star trader at whatever, name your favorite bank, they're like, oh, he's really good. Or the star salesperson, oh, they're really good. Say the salesperson, they're excellent. Let's have them run the sales desk. Well, they were really good at their job. Were they really good at running the sales desk? I don't know, maybe, but those two things aren't immediately obvious. And so I think that I had to learn that, it's not all about me. It's pretty much not about me at all. It's about everybody else. The other thing I had to learn how to do, and that was actually before I got here, was stop redoing everyone's work, because I'm not necessarily right. When I got here, that was actually easier. So there's a guy on my team who's been in equity markets for 30 years longer than me. He understands them way better than me. So it was actually much easier for me to not come in and kind of put my own spin, because I'm fully aware that he's got this edge I just don't have. But I think the other part of that is I kind of had to learn how I do have views that come through, right? And there are some things that I want the team to follow on. But I think the way that the coach kind of helped me was, how do you phrase what you're saying in a way that people want to collaborate with you and don't feel like you're jamming stuff down your throat? At the same time, how do you get involved in their projects without seeming like you're micromanaging them? Because if I don't have some sort of hands in what's going on, I just won't. I'll be out of touch with the markets, and then I'm completely ineffective, right?
Yeah, I guess ultimately as CIO, what you do have control over is the investment process. Now, obviously, you have a board, and that dictates certain things. But ultimately that's your sphere of influence. I mean,
Yeah, good point.
And you could go with different approaches there. It could be consensus, or it could be you get the call, or So what do you think is a good way to run an investment process that harnesses the skills of everybody, but ultimately, you have the final say, I guess, or you make the final recommendation to the board?
Yeah, I think it matters on what type of organization, if it's big or small. So I don't think like Chris Ailman probably couldn't run a completely consensus organization. He has too many people on staff, right? But he can probably do it with his senior folks. I have a really, really small staff. Everyone votes on every single investment that goes into the portfolio, including me. My vote is not the only one that matters, but I think if I voted it down, probably wouldn't get in.
Right.
It hasn't really happened yet. The closest I've come is to saying I have major reservations. You need to spend another 6 months on this. And they haven't come back to me yet. But I run a very, very consensus-oriented team. So one example is like we're considering something in China right now, and there's a lot of feelings both on the board and internally about what that means and what we want to do there. And I want everyone to be involved in that discussion, like literally everybody on the team. In terms of my board, we did change the investment process. We have a lot of authority now on the investment side. So we used to have to take all investments to the board. We don't do that anymore unless it's over a certain amount of the portfolio.
Okay.
That's been really great because it cites us and makes us feel like we have ownership. It also puts the burden on, or not a burden, responsibility on us to educate the board. And actually, I would say we are over conservative about telling them what's going on in the portfolio just because they're not seeing every single one that comes through anymore. So we're very communicative about how things come into the portfolio and if it fits with their view, because the board, I think, has a tougher mandate than I do. They have to decide what's best for the retirees. I just have to work within the risk limits and try to hit my bogey.
Right. And I mean, you talked about that relationship with the board and education. Is that, presumably you have people who are non-investment experts and you're trying to dumb things down somewhat or simplify things? Does that create risk that, communication risks, or do you think that process works reasonably well?
Yeah, it's tricky. It's almost, I think, but yes, it create risk, I think, on their side to some extent. It's almost as if I asked a manager for position level transparency, right? If I'm getting that, then I better stay on top of what they're doing, because I now know what they've got, and if I miss something and don't act, that responsibility is on me. Whereas if I just go into some sort of commingled account, say, well, theoretically you could say, well, I didn't know they were doing that, even though maybe you should. I think like the more transparency we give the board, the more responsibility is on them for sure. But that's up to them, their level of comfort with what we're doing. I do think they're very good at determining common sense and if something makes sense for their portfolio, because to be honest, a lot of investment strategies are not all that complicated. You can really distill them down into a couple bullet points that I think we can all explain in lay terms.
Okay. I mean, it's interesting as you talk about the role, it's obviously investment underpins everything you do, but at the same time, you've got kind of a communication element to the role, and there's a management element role. And then there's like an education element, people management, all of those elements. And then the actual hard investing is a component too. Do you think that's a great fit for your skills, et cetera, that it's not just investment? Or, are there times you'd say, oh, I'd love to just run an unconstrained portfolio and not have to worry about any of the other stuff?
Yeah, well, I mean, I guess if I want to run an unconstrained portfolio, I could do that in my PA.
Right, yeah.
Yeah, part of me wishes that I could, right? But at the same time, I know who I am. I'm not the world's greatest investor. I do think I'm a good boss. I do think I hate my people. We have a ton of fun. And I think I have found that it wasn't, if you'd asked me 5 years ago what I want to be, like a coordinator of people was not it. But I do think because my team is so strong here and I'm learning a ton for them, this is a really good fit, right? Like they are teaching me stuff. And one of the biggest challenges about being a CIO in your 30s is that everybody thinks you have learned everything and you haven't. You have so much more to be learning. And I'm in a really lucky spot that as long as I let them do their day jobs, they can still teach me what they know. So there's like, for example, my deputy CIO here is maybe the best person I've ever seen in my life at cash efficiency in a portfolio context. And also like very good about how to set up accounts and that kind of thing, and how to structure transactions. And if I take the stuff out his plate so that he can teach me that kind of stuff, then I'm very, very lucky, because I just don't know that would happen in another context.
Great. Well, we're getting towards the end of the conversation. I guess it's, as we typically wrap up these conversations, we like to get a perspective from people about advice they would offer to other people who want to, develop a career into a CIO or that type of role, or to get more proficient in managing a multi-asset portfolio or running asset allocation plans. What has been helpful to you, or what advice would you give somebody who was, progressing through their career and they wanted to develop their skills, or things to read, things to do? Any thoughts on that?
Well, it depends on what they're good and bad at. I really liked having a management coach. I would try to get involved in the investment committee meetings, not to sit, just to listen. So you may not work on real estate, but it might be helpful for you down the road to know what goes into the real estate portfolio. But my number one piece of advice that I say every time someone asks, well-meaning people tell you need or should do something before your next step, just ignore it. Just go ahead, fake it till you make it.
Just go for it. Go for it now. Yeah, there's no step in between.
Yep, exactly. Well, I mean, and the worst thing that happens is you don't get it.
Absolutely. Right? Well, great. We're literally just up to the hour, so I think that's a good natural point to sign off. It's been fascinating to get your perspective on all of those points. Thank you very much for joining us today.
Thanks for having me.
So with that, I'll pass it back to Niels.
Thank you so much, Alan and Elizabeth, for a very enjoyable conversation. I loved Elizabeth's view on the challenges that CIOs are facing in a world with higher inflation, and what it means to have a 7% return target hanging over you. And of course, it was so refreshing to hear a large allocator basically not caring if a particular strategy is a quote-unquote asset class. And finally, great to hear someone asking real questions about all the assumptions that goes into the classic mean variance optimization model. Make sure you go and follow Elizabeth and Alan's work, because as you can tell from today's conversation, there are many exciting facets to building a well-diversified portfolio, and we really look forward to exploring many more of them as our series continue. From Alan and me, thanks ever so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.